Look, I need you to pay very close attention to what I'm about to tell you, because what's happening right now in the gold and silver markets is something most people won't see coming until it's too late. And by too late, I mean the opportunity to position yourself will have completely evaporated. We're watching something unprecedented unfold. The physical gold market is experiencing a supply crunch that's unlike anything we've seen in modern history. And I'm not talking about some theoretical shortage that might happen someday. I'm talking about right now, today, as I'm recording this. Let me paint you a picture of what's actually happening on the ground. Major bullion dealers across the United States are reporting delivery delays that would have been unthinkable just months ago. We're talking about 4 to 6 week delays on standard gold bars and coins. Some dealers have completely stopped taking orders for certain products because they simply cannot guarantee delivery. Now, you might be thinking, okay, so there's high demand. That happens sometimes. But this isn't just high demand. This is a fundamental breakdown in the supply chain that's been carefully managed for decades. The London Bullion Market Association, the LBMA, which is essentially the central hub of the global gold trade, has seen its registered gold inventories drop by over 30% in the last 18 months. That's millions of ounces that have simply left the vault and gone into private hands. And here's where it gets really interesting. The COMEX, the Commodities Exchange in New York where gold futures are traded, is showing something that should make every investor sit up and take notice. The ratio of paper gold contracts to actual physical gold available for delivery has exploded to levels we haven't seen since the financial crisis. We're talking about more than 100 paper claims on every single ounce of physical gold in the registered vaults. Think about what that means for a second. If even a small percentage of those paper contract holders decide they want actual physical delivery, the entire system seizes up. It's like a bank run, except instead of people lining up to withdraw cash, it's institutions demanding the gold they thought they owned. And that's exactly what's starting to happen. We're seeing a surge in delivery requests that's putting enormous pressure on the system. In recent months, the amount of gold standing for delivery has been running at 2 to 3 times the historical average. The people who hold these contracts are saying, I don't want your cash settlement. I want my gold. Now let me tell you about something that happened that most people completely missed. There's a major European bank, and I'm not going to name them because this information came through private channels, but this bank recently tried to take delivery of a significant amount of physical gold from the LBMA. They were told there would be a delay. Not a day or two. Not even a week. They were looking at a multi-week delay to get their own gold. This is a major financial institution with deep relationships in the market, and they couldn't get immediate access to physical metal. What do you think that tells us about the state of the market for regular investors, for people like you and me who don't have those kinds of connections? The smart money has been reading these signals for months. Central banks around the world have been on an absolute buying spree. We're not talking about modest accumulation. We're talking about the largest sustained buying program in 50 years. In the most recent quarter alone, central banks added over 200 tons of gold to their reserves. That's the equivalent of about $7 billion worth of gold being pulled out of the market by official institutions. And it's not just the usual suspects. Yes, China and Russia have been aggressive buyers, but now we're seeing countries like Poland, Singapore, and even smaller nations ramping up their purchases. These are sophisticated actors with access to the best intelligence and analysis money can buy. They're not buying gold because they think it might go up a little bit. They're buying because they see something coming that makes holding paper currencies look dangerous. Let me tell you a story that illustrates what's really happening here. Back in the early 2000s, there was a German investor named Wolfgang. Wolfgang had built a successful manufacturing business and had accumulated significant wealth. He kept most of his assets in traditional investments, stocks, bonds, real estate. But he had one unusual habit. Every year he would convert a portion of his profits into physical gold, which he stored in a private vault in Switzerland. His friends thought he was paranoid. His financial advisor told him he was making a mistake, that gold was a dead asset that didn't generate returns. Wolfgang just smiled and kept buying. Then 2008 happened. The financial crisis hit, and suddenly everyone wanted gold. The problem was there wasn't enough to go around. Premiums on physical gold exploded. People were paying 20, 30, even 40% over spot price just to get their hands on coins and bars. Wolfgang's friends, the ones who had laughed at his gold buying, were now calling him desperately, asking if he could help them acquire physical metal. His financial advisor, the one who had called gold a dead asset, quietly started recommending gold to his other clients. But by then, it was too late to get in at reasonable prices. The opportunity had passed. Wolfgang told me later that the most important lesson from that experience wasn't about the money he made. It was about understanding that when everyone wants something at the same time, price becomes irrelevant. You simply cannot get it at any price because there isn't enough supply to meet the demand. We are approaching that moment again, except this time the dynamics are even more extreme. The difference between now and 2008 is that back then, the shortage was driven primarily by investor panic. People were scared and wanted a safe haven. This time, we have investor demand, but we also have massive institutional buying, central bank accumulation, and a supply side that's been constrained by years of underinvestment in mining. Gold mining production peaked several years ago and has been declining ever since. The easy gold has been found and extracted. New discoveries are rare, and when they do happen, it takes a decade or more to bring a new mine into production. Meanwhile, the existing mines are getting deeper, more expensive to operate, and producing lower-grade ore. The industry is running harder just to stand still. And then there's silver, which has its own unique dynamics that make the situation even more compelling. Silver is consumed in industrial applications at a rate that far exceeds gold. Every smartphone, every solar panel, every electric vehicle contains silver that will never be recovered. It's gone forever. Unlike gold, which is almost entirely recycled, silver is used up and disappears from the available supply. The Silver Institute estimates that we're running a structural deficit in the silver market. That means demand exceeds new supply from mining and recycling. That deficit is being filled by drawing down above-ground inventories. But those inventories aren't infinite. At some point, and we may be very close to that point, the available inventory gets depleted to a level where the market simply cannot function properly. I want you to imagine what happens when that moment arrives. You have industrial users who need silver to manufacture their products. You have investors who want silver as a store of value. You have a futures market with massive paper positions. And you have a physical supply that cannot meet all of that demand simultaneously. Something has to give, and what gives is the price. It doesn't go up gradually, it gaps up violently as buyers compete desperately for whatever physical metal is available. We've seen this movie before. In 1980, silver went from around $5 an ounce to over $50 in a matter of months. Now, I'm not predicting we'll see that exact scenario play out again, but I am telling you that the conditions for a similar supply squeeze are building right now. The inventories are low, the demand is high, and the paper market is massively overleveraged. Here's something most people don't understand about how these markets actually work. When you buy a gold or silver ETF, you think you own gold or silver. But what you really own is a share in a trust that claims to hold gold or silver. And while the major ETFs are generally well run and do hold physical metal, they have clauses in their prospectuses that allow them to settle in cash under certain circumstances. If there's a genuine shortage, if the trust cannot source physical metal to meet redemptions, they can simply pay you the cash equivalent and send you on your way. That might sound fine until you realize that the whole reason you wanted gold or silver in the first place was because you didn't trust the cash. You wanted the physical asset. But in a crisis, that's exactly when these cash settlement clauses get triggered. You end up holding paper when you thought you had metal. Now, I want to take a quick moment here because this is relevant to a lot of people watching. If you're sitting on retirement accounts, IRAs, 401ks, and you're concerned about what I'm describing, there are ways to hold actual physical gold inside those accounts. I put together a free guide that walks through exactly how gold IRAs work, how you can roll over existing retirement funds without tax penalties, and what you need to know about storage and custodians. It's linked in the description below. If you've got 6 figures or more in retirement savings, it's worth understanding your options here. All right, back to what's happening in the market. The institutional players are positioning themselves for what's coming. I've been tracking the commitment of traders' reports, which show the positions of different types of market participants. What we're seeing is that the commercial traders, the big banks and institutions that typically bet against gold, have reduced their short positions to the lowest levels in years. These are the smart money players who have access to order flow and inside information. When they step back from shorting gold, it's a major signal. At the same time, we're seeing massive inflows into gold by sovereign wealth funds and pension systems. These are long-term institutional investors who don't trade in and out. When they buy to hold, and they're buying size. We're talking about billion-dollar positions being established quietly, away from the headlines. There's a geopolitical dimension to this that cannot be ignored. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with several new members, have been openly discussing alternatives to the dollar-dominated financial system. And at the center of those discussions is gold. They're talking about trade settlement in gold, about gold-backed currencies, about creating a new international monetary system that doesn't rely on Western financial infrastructure. Now, whether they can actually pull that off is debatable. The dollar's dominance is deeply entrenched, but the mere fact that these conversations are happening at the highest levels of government is significant. It signals a loss of confidence in the existing system. And when confidence erodes, people move to hard assets. They move to gold. Let me tell you about another person I know, a woman named Sarah who worked in finance for 30 years. Sarah was a traditional investor, very conservative, very by the book. She had her retirement money in a balanced portfolio of stocks and bonds, exactly what her company's financial advisor recommended. She didn't think much about gold. It wasn't part of her world. Then she started noticing things at work. Her company, a major financial institution, started holding internal meetings about commodity exposure. They brought in experts to talk about inflation hedging. They started offering gold investment products to their high net worth clients. Sarah paid attention. She started doing her own research, and what she found alarmed her. She realized that the financial system she had worked in for 3 decades was far more fragile than she had understood. She saw the debt levels, the money printing, the derivatives exposure. She saw that the very institutions she had trusted were quietly positioning themselves for a crisis while telling their retail clients everything was fine. Sarah made a decision. She took 20% of her retirement portfolio and moved it into physical gold and silver. Not ETFs, not mining stocks, physical metal that she could hold in her hand. Her colleagues thought she was crazy. Her financial advisor tried to talk her out of it. But Sarah had seen enough to know that the conventional wisdom was wrong. That was 3 years ago. Since then, her gold position has significantly outperformed her traditional portfolio. But more importantly, she sleeps better at night. She knows that no matter what happens to the banks, to the stock market, to the currency, she has real wealth that cannot be inflated away or confiscated with the click of a mouse. The window for making that kind of move is closing rapidly. We're in a unique moment where physical metal is still available at reasonable premiums, but the signs of shortage are everywhere. It's like being in a theater where you smell smoke but the alarm hasn't gone off yet. The smart people are already moving toward the exits. The question is whether you're going to wait for the alarm when everyone else is trying to get out at the same time. Let's talk about what happens next, because the trajectory from here is becoming clearer. We have several forces converging simultaneously. We have supply constraints in physical metal. We have massive institutional and central bank buying. We have a paper market that's over-leveraged and vulnerable to a squeeze. We have geopolitical tensions that are driving countries away from dollar dependence. And we have inflation that, despite what official statistics say, is eroding purchasing power at a rate that's making people desperate for protection. When these forces reach a critical mass, and we're very close to that point, the price action is going to be explosive. We're not talking about gold going up 10 or 20% over a year. We're talking about the kind of move that happens in weeks or months, where the price gaps up and never looks back. Where premiums on physical metal go from 5% over spot to 30 or 40%. Where you simply cannot find metal at any price because it's all been bought up. I've studied every major gold and silver bull market going back 100 years, and there's a pattern that repeats. The early stages are slow and grinding. The metal goes up a little, pulls back, goes up a little more. Most people ignore it. Then something happens, some catalyst. And suddenly everyone wants in at the same time. That's when the real move happens. That's when fortunes are made and lost based on whether you positioned yourself before the crowd arrived. We are in the late stages of that early grinding phase right now. The catalyst could be a banking crisis, a currency crisis, a geopolitical event, or simply the market waking up to the supply shortage that's already here. But when it comes, it's going to move fast. Faster than most people can react. There's a concept in market psychology called the availability heuristic. It means that people judge the likelihood of something happening based on how easily they can recall examples of it happening. Most people today cannot recall a time when gold and silver were in genuine shortage. They've lived through decades where you could walk into any coin shop and buy whatever you wanted. So they assume that will always be the case. They think they have time. But the people who lived through the late 70s, who remember what it was like when gold went from $35 to $800, When silver went from $5 to $50, those people understand that markets can change character overnight. They remember the lines outside coin shops, the premiums that made metal unaffordable, the feeling of having missed the opportunity. History doesn't repeat exactly, but it rhymes. And right now, we're hearing the same rhythm that played out in the 70s, in the 2000s, in every period when faith in paper currencies eroded and people rushed to hard assets. The difference is that this time, the imbalances are larger, the debt is higher, the money printing is more extreme, which means the eventual resolution is likely to be more dramatic. I want to be very clear about something. I'm not telling you this to create fear or panic. I'm telling you this because I believe people deserve to understand what's actually happening in these markets, beyond the sanitized narratives you get from mainstream financial media. The information I'm sharing is based on data, on market structure, on the behavior of sophisticated institutional players who have no reason to lie about what they're doing. The opportunity that exists right now is the opportunity to position yourself before the crowd figures out what's happening, to acquire physical metal while it's still available at reasonable prices, to take a portion of your wealth, whatever makes sense for your situation, and put it into an asset that has preserved purchasing power for 5,000 years. Because here's the thing about gold and silver. They're not investments in the traditional sense. They don't generate cash flow. They don't pay dividends. What they do is maintain their value over time while paper currencies lose theirs. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought 100 years ago. Can you say the same thing about a dollar, about any paper currency? The wealthy have always understood this. That's why every major family fortune, every sovereign wealth fund, every central bank holds gold. It's insurance against the inevitable debasement of paper money. It's the asset you hope you never need, but are grateful to have when the system shows its cracks. We're seeing those cracks right now. The banking system required massive intervention just months ago to prevent a cascade of failures. The government debt is growing at a rate that cannot be sustained. The currency is being debased through money printing that has no historical precedent. And the people in charge have no solution except to do more of what created the problem in the first place. In that environment, holding gold and silver isn't speculation. It's common sense. It's recognizing that the emperor has no clothes and positioning yourself accordingly. The people who will regret their decisions aren't the ones who bought metal and didn't need it. It's the ones who needed it and didn't buy it. The days ahead are going to be volatile. We're going to see headlines that scare people, market moves that don't make sense, narratives that try to convince you that everything is fine. But underneath all of that noise, the fundamentals are clear. The supply of physical metal is constrained. The demand is accelerating. And the paper market is a house of cards waiting for a strong wind. Your decision is simple. Do you wait and hope that you'll have time to act when the crisis becomes obvious to everyone? Or do you act now while you still can, while metal is available, while premiums are reasonable, while you have the luxury of making a calm, rational decision instead of a panicked one? The opportunity of a lifetime isn't about catching the perfect bottom or timing the exact top. It's about recognizing when the risk-reward is so asymmetric that not acting is the bigger risk. It's about understanding that sometimes the safest thing you can do is take action before you're forced to. We are in one of those moments right now. The supply shortage is real. The institutional buying is real. The geopolitical shift away from dollar dominance is real. And the window to position yourself is measured in days and weeks, not months and years. What you do with that information is up to you. But don't say you weren't warned when the history books look back at this moment and ask why so few people saw what was coming.